Thanks for joining us for the market update for the month of June. June was actually fantastic. I mean, the big high-tech companies were just going crazy. We had our Apple, Microsoft, Google, Nvidia. They were all just going nuts, and which is a good thing. I think the S&P was up about, I shouldn't say think, it was up 6.25%. In Canada, the S&P and TSX was up 2.68%. And everywhere, globally, every market was actually doing really well. As always, though, remember, if you have questions, don't hesitate to call Kevin, David, or myself. We're happy to get together. And again, I'm passing it over to the guys to finish up the market update for the month of June. Thanks. Take care. Bye-bye.
David, what was driving the markets in June?
As was the case for the bulk of 2023, we've definitely seen technology companies continue to lead the market forward in June. There's certainly been a bit of a enthusiasm, if not maybe a frenzy, for companies that are involved in the artificial intelligence space. You look at Nvidia, for example. It's the latest stock to break into the $1 trillion valuation range. And Nvidia produces advanced microcomputing chips that definitely have a lot of utility as it relates to cloud computing and artificial intelligence and just increasing network speeds. So we're starting to see companies like that be rewarded in this marketplace. We're also seeing a broadening of the rally, though, too, which is a very encouraging sign for stock bulls. So for much of 2023, it's been your mega cap technology companies like Google, Apple, Nvidia, Microsoft, Amazon sort of leading the charge and leading the rally. But in the back half of June, we saw that rally broaden out quite a bit. So your small cap companies, value stocks, and the S&P 500 equal weighted index as it compares to the market weighted index of the S&P 500 had its biggest outperformance in quite some time. So those are all just indicators that are showing that the market rally has broadened, which is good. We've also seen inflation starting to cool a bit. So in Canada, the headline inflation number for May came in at 3.4% after it had been stuck sort of in that 4.4, 4.5% range for a few months. Now, the Bank of Canada also did hike interest rates by a 0.25 percentage point at the beginning of June. And that was, again, in response to the fact that inflation had sort of been hanging around that 4.5% mark for a few months in a row. And again, the banks want to see that inflation number continue to trend down towards that 2%. So seeing inflation cooling in Canada is an encouraging sign. All the while, the economy is still doing well. In Canada, the first two quarters are positive economic growth, and the same was true for the United States. And if we remember back in 2022, there were two negative quarters of economic growth back to back in the United States, albeit slightly negative. But that is typically an indicator of a recession. So, who knows? Everyone's calling for a recession to eventually happen here, but we never know. Maybe it did happen last year, and we will skirt that recession altogether. Only time will tell. Kev, can you talk about current cash levels in the market?
Yeah, investors have approximately $5.42 trillion in cash and short-term treasuries at the moment, marking the highest level on record. Now, this is understandable because in 2022 we saw stocks and bonds suffer a simultaneous decline amidst rising interest rates. So investors who want a bit more security after going through 2022 have piled into cash so far in 2023. In past market troughs, money market and cash assets peaked shortly before the market bottomed. So today's record cash levels may be a bullish signal for the markets when considering history. During the global financial crisis in 08-09, for example, money market fund assets peaked 2 months before the S&P 500 index reached a bottom on March 9, 2009. The stock market recorded a 40% return over the subsequent 3 months and a 55% return over the following 6 months. Similarly, during the pandemic, money market fund levels reached a high a few weeks after the S&P 500 reached its trough on March 23, 2020. After a difficult 2022, risk-averse investors may want to consider allocating some of their cash to dividend-paying stocks and intermediate-term bonds, which have been offering their highest yields in well over a decade.
Yeah, those are great points, Kevin. It's as that chart shows, when money market or cash assets peak, typically we end up actually having a strong rally because again, people pile into cash amid pessimism, amid fear, and obviously sell their stocks. Maybe at more of a lower point, and then they eventually get back into the market once the rally begins. But ideally, if you have any short-term needs, as we always talk about with those three balls, if you need to spend money within the next couple of years on buying a car or a renovation on your home or something like that, certainly being in cash is a sensible thing to do because you want that guarantee. And at least with cash interest rates at 4.5% just for liquid cash right now, it's not a bad place to be because you're actually finally making some money on your cash. But if you have a longer term time horizon for your cash and you're willing to take on a little bit of risk, now may not be a bad entry point to look at those dividend paying stocks and maybe some intermediate bonds that are paying pretty attractive yields, the highest yields they have in well over a decade. So as always, if you have any questions about about your investments or the markets in general, please don't hesitate to get in touch with Harry, Kevin, or myself. And we hope you all have a great start to the summer.
Take care.